MACD is a commonly used technical indicator derived from exponential moving averages that can be used in both trending and range-bound markets. One of the reasons for its popularity is because of how easy it is to visually recognize the crossover of the signal line and the MACD line. The MACD indicator helps traders identify changes in momentum, which is key for identifying trading opportunities around support and resistance levels. Before discussing how to use this indicator to time your entries and exits, let's first address some steps you can take to identify when to look for trading opportunities. The situation to look for in a potential buying opportunity is to note a pullback down to support when the market is in an uptrend. A potential selling opportunity is a rally up to resistance when the market is in a downtrend. The reason for this is so that you can make sure to place trades in the direction of the trend. There is a very common saying in trading, the trend is your friend. Newer traders often don't follow this guideline, which can immediately put them at a disadvantage. The key to look for in using MACD to signal an entry is a crossover of the MACD line and the MACD signal line. A crossover of the MACD line up above the MACD signal line represents a buy signal, but remember, you only want to note this situation as a possible entry when the market is in an uptrend and has rallied down to support. Additionally, a crossover of the MACD line down below the MACD signal line represents a sell entry when the market is in a downtrend and has rallied up to resistance. Let's take a look at some examples. This chart shows a strong uptrend with a move down off of a high. We then note the MACD line crossing above the MACD signal line, which is our buy signal. It's important to wait for the candle to close to confirm the crossover, since we can see a cross in the middle of a candle only to reverse before the candle closes. So it's important to wait for the close before acting. Since we are entering on a reversal, this also gives us a good level to place our protective sell stop. We would place that stop a few pips below the low, which should serve as possible support, as we would not want to be in a buy position if the market moves down to print a new low. Now let's take a look at a sell signal. The situation we should look for is a move up to resistance when the market is in a downtrend. We would look to enter on a reversal back to the downside. A crossover by the MACD line down below the MACD signal line serves as potential confirmation of that reversal and offers an entry into the sell. We can then note the high as potential resistance and place our protective stop a few pips above the high. There will be times when we buy or sell, and the market will move to stop us out of the trade. After all, markets can do what they want when they want. A big order may come into the market that temporarily pushes the market down to a new low after we bought, or up to a new high after we sold. But the MACD can also give us a second chance to enter into the trade if we wish. Let's look at an example. In this example, the trend was up. So as price action pulled back down to a support level, we bought on the crossover by the MACD line up above the MACD signal line. The market started to rally, but then some selling pressure temporarily pushed the market down to a new low, stopping us out of the first trade. However, note that the MACD did not make a new low like the market did. This is known as positive divergence. It's simply when the market moves down to a new low, but the MACD does not. This is a bullish signal and gives us a second opportunity to enter once again into a buy. We can simply note the second crossover and treat it as a new trading opportunity. This means that we can place our protective sell stop below the second low and look for continued buying interest to push the market up. Let's now look at a second selling opportunity. The first crossover was confirmed, with the sell being at the open of the next candle. But the market moved up to a new short-term high as buying interest came into the market, stopping out our first trade. Although the market moved up to a new high, the MACD printed a lower high. This is negative divergence and signals an opportunity for us to enter into a second sell position. We can simply enter as the second crossover is confirmed and place our protective buy stop above the higher high. While this indicator can work on any time frame, like all technical analysis, the daily chart will typically offer the better trading opportunities, with the shorter term charts offering more opportunities. It's up to each trader to find the balance between solid opportunities and the number of trades they wish to take advantage of in their approach. But the key is, as always, to trade with the trend and not against it. Now, before wrapping up this lesson, let's briefly discuss some of the technical aspects of this indicator for those who are interested. The default values for the MACD are typically 12, 26, and 9. These three elements can be defined as follows. The MACD line is simply the difference between the 12 and 26 period EMA, or exponential moving average. The signal line is the 9 period exponential moving average of the MACD line. And finally, the histogram is simply a bar chart located at the bottom of the chart where the MACD and MACD signal lines are plotted. The histogram is a visual representation of the difference between the MACD and the MACD signal line. The 0 point of the histogram, meaning the point where the bars cross above and below, is referred to as the center line. When using the MACD indicator, we're therefore noting the difference between a 12 period exponential moving average and a 26 period exponential moving average, and placing a 9 period exponential moving average on that difference. Because of the number of moving averages involved, this indicator typically signals an entry later than both the RSI and slow stochastics. This is not always a bad thing though, as late signals can also keep the trader out of losing trades by delaying the signal to enter. Early entries can be followed by a move against the trade, which can result in a loss. This concludes our video on MACD. Thanks for watching and good luck with your trading.